Hello and good day. On behalf of Miles Franklin, I'm Drew Mason, and today we're happy to bring to you Jim Grant, the veteran publisher of Grant's Interest Rate Observer. Jim, thanks for taking the time to share your thoughts and insights with us. Perhaps we could begin today by asking your view on gold as a currency.
There are about 300 economists who think that gold is not money, and they argue their point very lucidly. Unfortunately for them, there are 3 billion people who think that gold is money. So gold has this property of appearing to be money to almost any human being except for those who have achieved PhDs in economics. And Robert Triefin in the 70s or 60s and Irving Fisher way before him were examples of the left-brained analytical professional economists who thought they had a better idea, such as the SDR or the euro. And they may have had a better idea for a market interval. Gold has often been, shall we call it, a pig, expected as an investment. But over the very long pull, gold is in a simple ocular way, to look at it, it's money. And nothing that they, the economists, can say or prove can contradict that simple fact that to most people upon sight, gold is money.
Jim, another view that's widely held in the media is that we're in the midst of a gold bubble. What is your view on that topic?
Here's the thing about gold. Today, down $30. It yields the same as it did yesterday, up $30. The price-earnings ratio is the same. Gold is in respect to valuation, is forever indeterminate. It is a sterile asset, to be sure. It's got no management, no conference call, no institutional bona fides, so it is a problem for the quantitatively minded investors. There's no way of determining what it ought to be worth. I think the gold price is the reciprocal of the world's faith in these central bankers. But it is a pure speculation. It is a speculation on the future of monetary events, as well as a reading of the present in monetary affairs. And for that reason, it is inherently and always a speculation. Gold is. So as enthusiastic as I get toward it, which is pretty enthusiastic, I try to check myself, because really it could be $500 an ounce next week as easily it could be $5,000 an ounce. I don't say it ought to be $500 an ounce, but it's not as if it's sold to $500 next week, it's not as if it would yield nothing or yield less. It would yield exactly the same as it does today. So it is, it's a tricky substance, this favorite metal of mine.
And when you think about the ways to own gold, Jim, is paper gold such as an ETF sufficient, or do you think that there is value to owning the physicals?
Personally, I buy the stuff just like Scrooge McDuck. Run my fingers through it from time to time.
And why not? Why don't you just buy the paper?
Oh, I mean, there's something atavistic or primitive about the stuff itself. It's a pleasure to behold and touch. That's part of its appeal as a monetary asset. It is tactile, ductile, forever flummoxing with respect to its valuation, or not flummoxing, it's forever indeterminate, but to look at, it's pretty fine. In fact, it just sits around looking good like some people that's what it is. And a little more substantively, the reason to own it is that it is meant to be your bottom dollar. It's meant to be that thing which they, whoever they are, can't take away. And in that sense, it helps to have the stuff itself rather than somebody's legal claim on it. So I think that it's useful to have some physical holdings of this stuff.
How about from your vantage, inflation versus deflation ahead? How do you think about
yes. Again, it's one of these, as a member of the tribe of Graham and Dodd, I have forsworn soothsaying and crystal ball gazing, and we all have opinions. And I assure you that mine are just as valid as the guy who drove you here from the airport in a taxi cab. Just as valid as that. I'll stand up for that forever. But we can't know The world is encumbered by debt. We know that, and we know that debt destruction is really the essence of deflation. We've had debt destruction. Ergo, we do have, are having deflation. Debt is collapsing in many parts of the world, not all parts. But even with this debt destruction that is palpably underway, the CPI is flattish. It's not down 20%. So I say there's an inherent inflationary bias built into things. But again, this is one. I think that gold is a hedge not against inflation or deflation. It's a hedge against monetary disorder. And you don't have to have a view of the future to see that is what we have.
Jim, what is your perspective on fixed income at this point in the cycle?
Well, the press and even professional Wall Street is in the habit of referring to treasuries as inherently risk-free, which comes as astonishing news to those of us who lived through at least a portion of the 35-year bear market, 1946 to 81, when they went from 2.5% to 15%. So I am of the view there are no good bonds or bad bonds, but only bad prices. Nothing inherently bad about bonds. On the contrary, they are nice instruments for producing income at a price. I think this is the wrong price.
You've been bullish on gold and the equity markets. Can you update us with your thoughts as to where we stand at this point?
We have no house view on the stock market. I'm the world's leading authority where it's not going. We do have a view, did a review on credit, that is to say, junk bonds and bank loans and corporate debt. And that view was very, very bullish starting in late 2008. And we kind of took that prophecy off the table last year. So we are on record in observing that at least the stock market a few months ago offered very little in the way of quantifiable value. If you go back and do the screen that Benjamin Graham did for an intelligent investor looking for stocks that have paid dividends for 20 consecutive years, have never had loss in 10 years, whatever his criteria were, very rigorous and in fact kind of quixotically unattainable. Just one stock met those criteria 6-8 weeks ago.
How about your thoughts on financial reform? Any strong opinions?
Yes, I have one reform to propose. That is that personal responsibility be substituted for collective responsibility, and that we ought to look back, not nostalgically but constructively, on the arrangements of yesteryear when bank stockholders were accessible. They got a capital call when the bank failed. That was individual responsibility. Now we have the FDIC and the TARP. In Brazil, the directors and principal shareholders of banks are accessible for their entire net worth in the event their bank fails, which focuses the attention of those directors and shareholders rapidly on the net worth of their institutions. I'm in favor of general partnerships in which the partners are liable for everything they own, not just for their options. So I think that the way to redemption on Wall Street is through the very well-trod avenue of individual responsibility for individual decisions. The capitalists ought to get the upside, and they ought to get the full taste of the downside. The trouble is they get one but not much of the other. So I say a symmetrical reordering of risk and reward on Wall Street is the way to go, which has zero chance of happening in Washington.